Hey everyone, this is Diggy here from ForexHabits.com, and in this video we are going to discuss another profitable trading strategy based on technical analysis, and this is based on the MACD histogram indicator together with moving averages on a price action trade. Now the MACD is a standard indicator that you get pretty much on every platform. It stands for moving average, convergence, divergence, but most platforms actually have the histogram version of this instead of the moving average version. And the histogram version looks like this. This is a daily chart of the S&P 500 that I'm just going to use as an example, but the strategy works on different charts, currencies, indices, stocks of different time frames, daily, 4 hourly, hourly. It doesn't really matter. The strategy can always be applied. Now, what the strategy does is when the MACD histogram, this has a zero line, like a neutral line, and it crosses above it and it crosses below it. Now we are going to make trades based on when the MACD histogram crosses over this zero line, but in conjunction with where the price action is compared to the moving averages. So if we get a cross from the MACD histogram through the zero into positive territory, and the price action is above the moving averages, and on this chart I have exponential moving averages, which I like to use 21, 50, and 100. If the price action is above these averages and there's a cross from negative to positive, then you want to go long. On the flip side, if we want to do short trades, we're going to do that when the MACD histogram crosses down through the zero line into negative territory, but at the same time when the price action is below the averages or has broken through the averages. So for example, in this position, when it has crossed to the upside, you can see here the price action is still below the moving averages. So although it turned out to be a profitable trade at this cross to go long from this position, it is a bit difficult because it's a bit of a chop and it was below the averages, so that's something that I wouldn't take. But if you look for here, for example, when the price action has started to cross down and break down through the moving averages, it's broken to the 21 through the 50, and here we get this cross to the negative territory. At this point, you could attempt a short trade because it's already below these two averages, and it's looking like it would go down, and that would have been a profitable trade indeed. At this point, we get a cross from the negative into the positive territory, but at this point you can see that the price action is above all three moving averages, so that would be a good position to enter a long trade. And look at the rally that this signal can generate and the profits that you can get. I mean, this went up from 1244 all the way up to 1418. That is a huge rally over a period of 3 months, and that could have been spotted just based on this pattern that revealed that. And then when you take a trade like this, you could just put a short stop loss, like where you enter it. For example, like if you would enter here after the cross, maybe after this day, you would enter at maybe 12.55. You would put your stop at about 12.32 and let it ride. If you get stopped out, you know, you base your position on that accordingly, but for the rest you can hold and look at the rallies that it can bring. Let's look at another example. Let's find another example. We have here we start to get across to the downside, and by the time it crosses maybe on the first day or the second day, it's already broken down through these averages, so you're about over here. So it's looking safe to follow the strategy because once again you've crossed through the negative through the zero line on the MACD histogram into negative territory, and the price action's already broken through the averages, so there's a high chance that it's going to follow down, and that's exactly what it did. So were you to enter here at this level, say at about 1300, you could put your stop just above this, about 1317, 1320, and you could ride this out. I mean, that's a stuff from 1300 to 1094. Wow, that's big. That's almost like 200 points, you know, in time of a month, pretty much. So that is the strategy, and it applies to different charts, currencies, commodities, indices, stocks, and it works in different time frames. I've just chosen the daily time frame, But keep in mind, if you trade on a daily time frame with this kind of chart, you're gonna have to hold positions for weeks, possibly even months, which is okay. Personally, I like that because it means I can just monitor my position from time to time. I don't have to stay glued to the screen all day. But if you're more of a day trader, you prefer to do this kind of thing on 15-minute charts, hourly charts, maybe even 4-hourly charts. But on 4-hourly charts, it would probably take you days for this pattern to do it, so you might have to hold for a couple of days, maybe a week on a 4-hourly chart. But on a 15-minute chart, you can do this in 1 or 2 days, like a position would turn out. So that is the MACD histogram strategy that I like to use. It's one of my favorites. It's very profitable, and it allows you to use a small stop, relatively small, with a big potential reward of multiple times the risk that you run when you enter a position based on that. Now, I explain the strategy in a bit more detail on my blog at forexhabits.com. You should definitely subscribe to email updates so I can send you more of these technical analysis lessons, and so I can send you profitable trading recommendations that can help you make more money and gain the freedom you want to do. So head over to forexhabits.com. See you next time. Cheers.